Did you hang out with Andrew for his birthday?
No, he's too popular, dude. He took my f***ing dog and hung out with everyone else. You should,
Yeah, I saw that he took your dog. I saw that he had your dog.
dude.
I'm
No,
like, oh,
let me send you the photos of his Instagram stories of him partying with my dog the whole day, and then like we didn't even get to see him. Hold on.
savage. Oh, hey, actually, can we just, since we're here, can we just get Andrew to come? Because I have to leave at like my 9:40 at the latest. I have like a hard stop.
Yeah, you're
Prep for
doing real work,
real
doing a
work.
deal.
Yeah,
Are you
man.
buying up a movie studio?
I wish. Actually, those aren't pretty expensive these days, and don't really want to buy
No, you
those.
could probably like. I'm pretty sure your company could buy one.
Yeah, burn
Then you
through
can
our
make movies.
capital. Yeah, burn through the balance sheet and have like no operating capital. Sure, that sounds good.
Do what you do best. Raise money.
Andrew is fixing his kettle.
He has technical issues.
Yeah,
Yeah, I guess
this
that could technically mean his kettle.
Have you guys traveled to India? Like when you go to a relatively remote place, there's like a tea seller, and usually he doesn't sell any tea. And when you are here, when you happen to pass by, he's very, very zealous. He will just stop you and say all the good things about you, just that so that you just stop at his store for a cup of tea. Once you stop, he start lighting up the fire and using a matchstick, and they start boiling the water, and they have this like hand. How do you call this? Thing to blow the wind into the stove.
Maybe that's what Andrew's doing right now. He's going and mining the copper wiring for his cable connections. He's literally mining copper and smelting it down to make a wire.
There he is.
There he is.
Good morning, sir.
So I heard that you.
Where's your kettle?
I heard you invited Alex's dog to your birthday party, but you didn't invite Alex. That's kind of mean, dude.
Look, when you put it that way, it sounds terrible, but that's not at all what happened.
No, but that is literally what happened, right?
Listen, maybe
Yes,
Alex's dog is
but-
cooler than Alex, okay?
Hello, Barbarians, and welcome to the 6th episode of the LLB podcast, Low Level Barbarians from Asia on Asia, with debate and discussion on trending topics with our usual host, man at the high ground, Dave Chang.
Still in a motel.
Still in Wisconsin. Soon to do an epic road trip from Salt Lake City to San Francisco. He's going to talk to all the VCs for us, raise
Nice.
nice
Sandhill
money.
Road episode.
Sure. Sure. I got my sleeveless vest ready.
With us, Jangan, the information super connector. How are you, Jangan?
I'm wearing my 12th t-shirt, Occupy Mars.
Occupy Mars. Very good.
Which I bought on Taobao.
And with us, the belated birthday boy, the master debater, Andrew G. How was your party last night?
I mean, I'm 34, so I party like a 34-year-old, which means we were back home by midnight.
Oh.
Okay.
Where did you go?
Honestly, we didn't do much. Like, so I took Judah, like Amy brought Judah over. We had a run. We spent like 5 hours in the forest yesterday, as I would now. And then I had lunch with some friends, which was actually a work meeting that turned into like, fun. And then I went out for dinner with 2 college friends. Yeah.
Very good.
No,
Your
my
debating friends.
my classmates from uni.
So basically, debating friends.
Yeah. and Jude,
Jude, that's right.
and Alex's dog without
That's right.
Alex.
Alex is cool. Alex sent the
Yes.
representative, so it's all right.
So for our first mini topic, are we really talking about Diablo 2 Resurrected or no?
We should definitely tackle this.
Well, Diablo 2 Resurrected is out. The reason why I never went to Harvard, Columbia, or NYU, I played too much Diablo 2. It's come back to destroy my career again. It's back in full force, remastered. It's amazing. I will be playing it. Dave will be playing it. I don't know about anyone else. If you guys want to play, come and join us.
Well, to make it a bit more relevant for the podcast, why is Blizzard's stock not reflecting social media sentiment for Diablo 2 Resurrected? Blizzard's stock is tanking, which is pretty sad
Well-
for a stock that's there's very few gaming stocks you can buy of this size, of multi-billion-dollar companies, and Blizzard just doesn't seem to be able to get its stock price up, which is kind of sad.
You have Tencent,
I
gaming stock.
yeah.
Yeah. But I mean, at this point, like, I'm just hoping out that some of the private unicorns get out, but it seems like they never will. Valve doesn't seem like they will ever go public. EA is the only one left.
I think private unicorns will be acquired before they can go public. and they will probably have the incentive to be acquired if they have like 1 or 2 games under their sleeves. So that's what happened with
Yeah.
Moonton, right? The creator of Mobile Legends. I mean, they were looking for a buyer for a long time.
Yeah.
Well, I mean, I think this is for a topic for another episode. Yeah, go ahead.
No, I was going to answer your question, Andrew, why Blizzard stock isn't reflecting the release of Diablo 2. I think a large part of that is actually because the way that the game was created, it doesn't have any microtransactions or ancillary income streams aside from the initial purchase.
Yeah.
So if you look at like sort of like the largest media property, IP properties in the gaming universe right now in modern times, they all have some form of monetization. They're either actually freemium, like they're just straight up free on the front end, and then you pay for cosmetic items. So Fortnite is obviously the big example here. But actually, I believe to this day, the most popular gaming title still is Grand Theft Auto 5, which is now like Grand Theft Auto Online. I think that thing's made like $3 billion in revenue or something. And basically what they've been doing is like they've released the base game, they sold the base game, but then they're also doing the monetization model of a lot of the premium games. So they're selling you like additional cars, additional outfits, additional whatever, right? And none of those elements are present in Diablo 2 Resurrected. So your upside is, it's great press and it's great PR. And I think people get really excited, especially if you're our demographic, because we grew up playing that game. We have really fond memories of it, but I'm not going to buy the game like 50 times, right? I mean, maybe some guy would buy it 50 times with his friends, but you can only make so much money out of me, and then we're essentially capped out for that particular IP.
Yeah, but I mean, I think it's a work in progress. This was a complete recode because the original, they had lost huge parts of the code base from the original game, and they had to like do some crazy voodoo magic to patch it back together. But I think this is just the base test case. Like the beta version was really buggy, but the initial release is really smooth. I think it's just a matter of time before they keep layering on patches with microtransactions and skins, this kind of stuff. But I mean, that's a separate topic.
Can I just quickly respond to Dave before we move to 1FC?
Sure.
Just because I think that's really interesting. So
Okay.
I think there's two things, right? One is like games are become like there's almost a division between games. You've got like the AAA titles like Diablo, Red Dead Redemption that people play for the experience, and then on the other side, games are starting to resemble fashion, right? So if you look at the world today, like, you know, NFTs are blowing up, and then you have games like Fortnite where all you're buying is a costume, right? It seems to me that it's people who like used to buy Pokemon cards now buy NFTs. People who used to pay for fashion now buy a skin on a game. And so that's like expanding a little bit like what the universe of what a game is. And so it's almost like a different like breed. Like when we speak, it's almost like they're like more comparable to fashion. And I think like slight subtext there, like that place is just going to blow up, right? So I don't mean to get gender specific, but like Bandersnatch was not Bandersnatch, no, what was Bridgerton was like the #1 most watched TV show in Netflix. Like Netflix just released their Tudum like analysis of TV shows, and so it just seems like as the demographics shift towards like a more male oriented like sport towards a much more mixed category, I think this area of like fashion games is just going to blow up over the next 5-10 years.
I mean, I agree
Yeah.
with you. I think this is sort of like a longer conversation we can have about the metaverse and sort of like, you know, that the line blurring between what is your physical life versus like a persistent digital environment. And increasingly, as you spend more time in these environments, then that becomes your life. And so like, yeah, the money you would have spent buying like a, I don't know, Hermes bag in real life, you would have spent buying some really cool like avatar sword or something in the game that you're participating in. But I think that's like a really long topic of itself that we should probably stay for another time. Yeah,
that's probably a one full episode.
I mean, it's one full episode probably, and like it's really what Dave says. So let's just move on for now. So we're the first topic being companies that have raised a lot of money, possibly have not lived up to expectations or valuations, maybe even. So the first company we're going to be discussing is One Championship, One FC, which is the local MMA media company based out of Singapore here. Very interesting. If you want to know the nitty gritty details, follow the Bloody Elbow Reporting, which is an MMA news outlet that's been tracking the story for quite a few years already. So One Championship has been around for about 10 years at this point, and They've raised a lot of money. And I'll take a quote from the most recent article from Bloody Elbow. As of January 1st, 2021, they raised a total of $276 million for the group. The second quote would be, they have also been very successful at spending it. As of the beginning of this year, they have reported accumulated losses of 273 million, right? Which is very interesting because the CEO himself has been reporting and on social media, on LinkedIn, that the company is doing very well. And the most recent was him citing a report from Nielsen saying that this is one of the largest media companies for Southeast Asia for martial arts. And I took a deeper look at it, and essentially what it is, it's based off social media reach. That's what he's citing. If you actually look at the actual data, but more interestingly in the details, right, is that they reported from 2019 to 2020, $400 million, or roughly $300 million in revenue. And essentially what happened was they created a Delaware company, sold IP to that company for $400 million. $200 million was in cash, 200 in equity. So it's just this very weird price transfer move, it seems like. I haven't really been able to brain it. I'll leave you one last quote before we start discussing this. Over the last 3 years, one championship has accumulated over $200 million in losses at a burn rate of almost $70 million a year. At this rate, one championship would be expected to have burned through the remaining cash by early next year. So guys, what is going on and what's going to happen with ONE FC?
I can start. I have a lot to say about this.
All right, go for it, Dave.
Yeah, I mean, so just a quick aside. So just to be clear about what you were talking about, Alex. So they basically sold IP to themselves and booked it as revenue. And just to clarify as well, the $200 million in cash, based off the reporting that I've seen, they haven't even received it yet. So it's just purely booked revenue. There's no actual transaction. So it basically it's nothing. It's all fluff.
Can I also say that for the early few years that they had reported revenue, in the revenue they had this thing called barter, right?
Yeah.
And barter essentially was like, you know, when you do trade marketing, like I get the value instead of paying cash, so they would book that as revenue.
Yeah.
And then in the past few years, they recently moved that to broadcasting. They don't tell you the breakdown of percentage of revenue, right? So you don't actually know of the broadcasting revenue, which is now called which is from barter. Like you don't know if there's actually any real revenue from that. And that's the only revenue that has been growing. Everything else has tanked from COVID times on the top line numbers. So just also to add more nuance that, you know, from the price transfer to the revenue.
Yeah, I mean, I think there's a lot of things you could say about this particular company. I think there's a lot of different angles, and I'm going to go through all of them, and I'll try to keep each one as succinct as I can. So just from like a business fundamental operations point of view, there's some. If you look at their business, right, they've essentially spent, as you said, 300 million, and they're booking, I think last year their group income was like, I think maybe 48, if you don't include that one-off transfer pricing that you have. And what's actually super interesting, right, is like, so you can make an argument that because it's a sporting event, and then because of obviously the COVID health situation, we have a depressed impact on their overall performance. But actually that's not true, because you have a lot of analogies in Western sports. So to give you an example, right? So the NFL recently renewed their contract with the major broadcasters and ESPN. So that contract is an 11-year contract, and it's worth 110 billion US dollars, which is actually double what the previous contract renewal was, right? If you look at ONE FC's broadcasting revenue, it's only grown like I think 6 or 7 million Sing dollars year over year, and that's including that weird barter trade mechanic that Alex was referring to. So what that really says to me is, like, if you think about it, there's really no demand for this product, or the demand for this product among their core customer is quite low. And when I say core customer, I'm not talking about like you and I as viewers or as audience members. I'm talking about the people that they actually sell this to, which is the TV stations and broadcasters, because they're the ones that actually monetize this thing, right? So I think Chatri had a really interesting quote where he basically said something along the lines like, all our metrics are trending in the right direction. I'm sure that given time, we will actually grow into the multi-billion-dollar business that we always were meant to be. And I think that's actually fundamentally true, right? Because if you think about it this way, like over a long enough time period, they will be the only they are, and they will probably continue to be the only dominant mixed martial arts promotion in the region. However, at that point, what we're really talking about is we're waiting for like our markets that they operate in to develop and mature to a rate where they can actually support that kind of valuation, right? It's not so much what I'm saying is like there's a natural cap based off the maturity of the region that we operate in, right? So that's from like an operational point of view. I think from just like more like a philosophical or fundamental point of view, it's a really interesting business because they've actually chosen to operate in sort of like the most zero-sum game there is, which is they're a media company, they're a content company. So they compete against every other entertainment class for your time. And that sort of goes into what we're talking about with like video games. So not only do they compete against UFC, which is obviously competitive of theirs, but they compete against TV, against video games, against books, against podcasting. And that's an increasingly both fragmented and competitive space, right? There's so much content and good quality content that's being put out that you really have to be best in class to really make a name for yourself. And I think that therein is sort of where another fundamental weakness, and maybe their greatest fundamental weakness lies, is they are branding themselves as a regional MMA promotion. So they're like very in their marketing materials, they're all very gun-ho and heavy about being Asia-centric, Asia first, Asian values. If they're an Asian promotion, that's very clear in their marketing and their branding. But at the same point, and then this is unfortunate to say, but when it comes to sports, what people really care about when they watch sports, they want to watch the best. They want to watch the best people compete against each other. That's why you have like the Arsenal, right? Arsenal is the most popular, or Barcelona, whatever. The top football leagues are like, even though you have local leagues, those like Euro Cup leagues are still the most popular ones because those are the best teams. And I think that dynamic exists in the UFC 1FC dynamic as well, right? So even if they are a Asian promotion, ultimately at the end of the day, what people care about is they want to watch the best fighters. And whether they're the best or not, it doesn't actually matter because the perception is that the UFC has the best fighters, and they're never going to do a cross promotion competition. It's never going to happen, right? So for basically the foreseeable future, they're sort of like a second tier relegated promotion that's really sort of like trying to, I believe, monetize or capitalize on like this like nationalistic spirit, but ultimately that only gets you so far when it comes to sporting content. And then I think the last point I want to make before I let someone else go, and I think this is super interesting, is if you look at who led their last 3 rounds, it's been Sequoia every single time. And so this actually brings up another question about sort of like what are their investors doing and what are their mindsets. So to be clear, right? Sequoia has a track record of doing this. They are known for investing in subsequent rounds. They make a assumption or they make a bet, and they typically push their chips in several times over the course of the relationship with that company. And sometimes, I mean, it depends on the company, right? If you're doing that for like, say, like WhatsApp or SpaceX, you look really, really smart. But sometimes that doesn't go as well for you. So what I'm trying to say is, I think, yes, basically, if Chatri were given, let's say 1FC, let's give like, say, maybe like 10 to 15-year runway for sort of our markets to mature enough where you could support like these billion-dollar broadcasting rights, and they had enough runway to actually make it, a Sequoia or whoever was actually willing to fund them for that amount of time, then yeah, I guess that, on like a purely technical level, that is true. But I think this move that they've made to transfer the IP rights to a US Delaware company, to me, that's sort of like indicative that they're sort of looking into a SPAC or IPO move. And I don't think that move will be very well received in the US based off what their numbers and what their performance is.
Sure, I have a few points. So, so a few years ago, I think even before the last 2 rounds, I think some of the early rounds, a friend of mine went into one of their pitching sessions, and I do remember back then the pitch is that we have 2 billion potential viewers, and of course, I mean, went into argument of what potential viewers actually mean,
Mm-hmm.
but I think. I think as you rightly point out, Dave. So I don't think that the market in Southeast Asia or the market in Asia in general is that big. So I have a bunch of friends in China who are diehard fans of MMA, and they all follow UFC. And when Dana White went to China, and they followed. I mean, all the news about Dana White, about the fighters they sign up in China, and one FC went to China as well, and they could only sign up sort of fairly mediocre fighters for the tour. And of course, they could invite the top ones for performance, whatever. But for the serious tour, I mean, the good fighters want to go to UFC, and that's for sure. And people who know Dana White would say that. I mean, compared to him, and Chatter's no match. I mean, in terms of aggressiveness, in terms of, I mean, I wouldn't say business acumen, but that guy is a beast.
Yeah, so sorry. Yeah, I think you're absolutely right. Actually, I missed this point out, but it's only add on to it. So actually, UFC's financials are public because UFC is part of William Morris Endeavor, and they just IPO'd in March of this year. So their financials are actually public. And to your point, Jongan, Dana White is a business monster. Like, I have like the headline stats for UFC. I think they did like $1 billion in revenue in 2020, and their like gross margins are like 49%. So their like EBIT is like 490 million US dollars on like $1 billion of revenue, which is incredibly impressive.
Yeah, I mean, my question would be like, then how did Dana White go about early days doing that? And I think that would have been the right blueprint. Like, if the market size is too small, right? To me, the more smart thing to do is build. I mean, it's the baseline of good quality would be good fighters. You have to really invest a lot in building high quality fighters first before you could even create the content, right? And then it's like, how do you find what's profitable? And then you have your natural market size that's profitable. And then it also, another way, I mean, if you want to do Southeast Asia because it's small, right? The other way is that why didn't they just focus more like on China then? You know, if that's the bigger market and that's where the diehard fans are, right? So
Yeah.
these are some questions I would that come to mind
So
when you guys talk
I'm
about
just gonna
this.
take a quick stab at this, right? Like, I think I'm hesitant to say too much about this topic for two reasons. One is I think look, there's like bad luck, and then there's also bad strategy, and there's bad execution, and then there's actually just trying really hard in something that maybe is a bit new, where nobody's really done too much, right? And so I want to give respect to entrepreneurs who try to do something different. And I think like Chatri is a great storyteller who's got his heart set on this route, and he's trying out different things, right? Obviously there's a bit of work to be done, and so let's take a step back here. First of all, UFC isn't exactly an ancient brand, right? 30 years ago, nobody really watched MMA. Boxing was everything, and MMA had to be created from the remnants of Gracie BJJ, a Brazilian school, and what is Muay Thai and a bunch of other sports thrown in, right? And this idea of like people just like bare knuckle boxing, or like using all of their limbs and head and every other parts of their body was just new at that time, and they were considered like a weird underground sport for a while. Today UFC is as respectable as boxing, right? I think what happened was more people saw the opportunity that there was this cake is going to grow, and it's a new cake. You can keep building on that cake and build like the idea of MMA hasn't fully evolved yet. It's still developing. What exactly is MMA? Where does it get involved, right? And I think Chatri saw an opportunity to get in there. I mean, if you guys know, Khabib is also launching Eagle Fighting Championship, right? So it seems like there's space. And to be honest, he's the greatest fighter MMA has ever seen, right? And if he says, I'm going to split out from Dana and start my own thing, now whether or not he gets the backing and gets to execute and has the business ability to do that, that's a separate topic. But the point is, it's a very nascent sport. Like Dana had the ability to bring in lots of people, create a whole thing out of it, right? Now, there's like a couple of very interesting things here. Like number one, why is Sequoia behind them, right? And then number two is, does the business model even make sense? Like, let's tackle that. Now, Sequoia. Now, first of all, with VC, the way you get returns is by doubling down on your investments when you see like trajectory is going to look good, right? You want to be 10 or 15% of a company that's going to be large, as opposed to keep diluted until you're a single digit percentage. And obviously, like I'm not gonna like if Sequoia sees something in him, it can't just be like he's a great storyteller. There must be something behind there. My theory is a couple of things. Number one is on this idea of localization. I think that that Southeast Asia has its own specialties. Muay Thai is massive here, right? And people do have a bit of loyalty to fighters from a certain region. I think what he's trying to do with ONE FC is bring like a trans-regional Southeast Asian identity of fighters who are primarily like standing as opposed to grappling fighters, and then bring them onto like this larger point, right? Um, he's also been pretty successful at getting a lot of UFC fighters to jump over to ONE FC, right? You had like there was some shocks, like Demetrius Johnson was shocked. I don't know if Eddie Alvarez is still in ONE FC, but like he's got a couple of big name fighters to jump from UFC to ONE FC. Um, and in that sense has been fairly successful in trying to build this sort of brand. Now the runway is long, like to be able to build something like this and make sure it gets onto everybody's views, that's a bit hard. I think what they tried to do and why they also got Sequoia in, and this is the second point, is that they tried to build this like multimedia franchise that was more than just uh boxing. I don't know where that is, but this was what I heard in market like a couple of years back. Like it was going to be an app where you get to, look at different kinds of sports data and create like a one-stop shop for all your different sporting Southeast Asian or Asian needs. I don't know where they are on that story of where the app is, but that clearly didn't happen. On this topic of like barters and cash, right? The problem is this: when you're new, nobody wants to give you sponsorship money, and it's going to be really really hard to justify like selling ad space. It takes a while to pick up there, so in the beginning everyone just gives it for free, right? But what they do with giving it for free is they ask you to give something in return, and it's typically some kind of in kind. Some of that stuff is really valuable. Like when one came to the company that I used to work at, like we ended up giving them, I think, vouchers or some kind of promotional stuff that they could give out to their spaces in return for getting some kind of ad space. So they were doing it because I was reluctant to spend at that time on a very new property. This was like 4 years ago. Um, and so that's going to happen for a while as people figure out, are some of the stats true? Do women really watch this show, or is it just like men, and like get a lot of the numbers down? But at some point they need to convert the barter number into the actual cash, right? Because promotional vouchers don't get you anything. The test is whether you can switch fast enough, and I think they're struggling a bit there in this last 2 years. I hope they get out of it. I hope they figure it out. The world could use a bit more of like some new sports media giants. Um, and but I'm not sure if they're just trying to repeat something that's already worked and then doing it better, or they're actually inventing something new.
Well, that's an interesting. Okay, so yeah, I think there's a couple of points. I'm not saying these things aren't value judgments against the entrepreneur, right? I don't think anything that we say is on this podcast on the show is meant in that
Yeah.
way. But for me, it's really a question of uh, yes, why would you build your business in this way, right? I think maybe that's a better question. And to me, this kind of like sort of falls into this paradigm of like a fake it till you make it type thing, right? I mean, we're in the middle in the U.S. right now of a Theranos trial with Elizabeth Holmes, and to a certain extent, this is very similar, right? In the sense that she for years has said, "Hey, I have this great revolutionary product, blah 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 blah," but at the end of the day, it was all kabuki, right? And similar, right? You have a charismatic founder, you have a product that on the surface, if you look at sort of like the surface level metrics on like views or followers or whatever, right? I'm sure it looks great, but then like what are the fundamentals that are really are underneath, right? If you look behind the hood and sort of is this sort of business, or is this a sort of model that we as people in the ecosystem should encourage, or is this something that we should be like, well, look, there are certain games that are being played here, and let's just all be honest about what it is that's happening here and call things out for what it is. That's my point.
I think my point here is that David pointed out that some of the similarities between Theranos and my take about Theranos is always, I mean, I'm not sure what really went behind. I've read the book, but nobody could really get into what the duo or Holmes was thinking back then, right? And initially, I mean, fake it until you make it is, I mean, it's the mantra that many entrepreneurs take, right? But at which stage that it turns into what we call fraud. knowing that the product wouldn't work, or still having the faith that product not work is going to work, or knowing for sure that it's not going to work, but you are going to continue to put a facade saying that, okay, I'm going to make it. I'm going to make it. I think one thing to dig into it is probably the psychological effects of things. You guys probably looked at the rogue traders, right? I mean, the traders who have lost lots of money for the banks they're working for, and what do they do next? They always try to take riskier bets to try to recover that. So I think psychologically, for you to come out and say that, look, I screwed, it didn't work. Sorry to my board, sorry to my investors, sorry to the public. I think that's a very, very hard thing to do. I mean, I don't know if I would be able to do it in that situation. And what I would, I mean, putting up a sort of brave front when things are working against you is probably easier than just telling the world that, look, guys, it's not going to work out.
It's a very, very good point. And I think there's only a few stories of entrepreneurs that I know that have done this. Like the one that comes to mind was Justin Kahn with Atrium. He took over $100 million. I don't think he lost all of it, but he lost a big portion of it, but he returned the remaining balance. But that's, like you said, probably massively hard to do. Any final comments before we move on?
You look at, I mean, I'm not sure if you guys have been following the posts that Chatri has done on LinkedIn. I mean, enormously popular. And every time he posts something, like hundreds of likes, hundreds of comments.
Yeah.
But I do
Very
remember
popular.
a few months ago, about a year ago, and he posted something saying that the quickest $100 million raised from, and he named Sequoia. He tagged, I think, some of the partners of Sequoia India based here. And he said he went for dinner. I think along the lines of he went for dinner, and they had a like very good chat, and they promised like 100 millions to him, etc., etc. And the funny thing is that post, as usual, got like hundreds of likes, hundreds of comments, and people saying that this is really inspirational, and no no response from the Sequoia partners who were tagged. And it felt to me that it's like a public statement saying that, hey dude, where's the $100 million you have promised to me? But of course I'm not going to dig into the details because I don't know what was promised.
Yeah, so I think it remains to be seen what will happen at 1FC. You know, Andrew has an interesting narrative. There clearly is a lot of work to be done. So shall we move on to the next topic?
Sure.
Okay.
Let's go.
Okay.
It's enough time, yeah.
All right, so second topic will be Insurtech in Southeast Asia. I think I'm going to reference Jangan's article from Momentum Works. I don't know who wrote this article on CXA, right? Which is I guess you could say it's a kind of Insurtech company. They had a brokerage arm, but it's more of a SaaS company that sells products to corporates in terms of HR benefits, right? And the article goes on to outline that, you know, CXA Group, they had to, in the past year, lay off a significant amount of their employees. You know, they've raised over $58 million. They have over 300 staff in Singapore. However, you know, despite all of this traction, they had the layoffs, and they also sold their brokerage arm, which, you know, for an insurance type business seems a bit of a red flag. They sold their brokerage arm to Pacific Prime, and they're focusing as a SaaS business. But what I wanted to set up for Insurtech, because I this year I made my first angel investment in technically an Insurtech company. Shout out to Oyen. If you have pets and you want to be insured, I've been talking at length for a long time with the founder, Kevin Hung, and you know, we had a few topics that I think were very interesting that could help set up this topic. Is that if you're looking at Insurtech in the region, you know, you really want to be looking at the customers and what are the trends and behaviors that are creating opportunities for innovation in product, right? And as a user myself of insurance in the region, it's just very painfully hard to understand it. It's very hard to engage with it. The user experience is when you get insurance, there's really no good technological product solution for it. And then the question is, you know, what is your way, like what kind of behavior can you see that could give you a nice niche? And what I decided on and what Kevin decided was that the pets and pets owners was an untapped market. They had products that had no traction, but as a pet owner myself, I really had this pain point. So it's like looking at the customer trends and behaviors. Secondly, like when you're looking at this, you want to look at distribution. You know, does the embedded model actually work, or do customers prefer dealing with agents or going direct still, right? And my take on that is that because the user experience is so bad, and these older insurance companies have a hard time deploying technological solutions or good product, that there's plenty of room like, forget the, AI, forget the machine learning, all this kind of nonsense that people will tell you. It's all nonsense for this region specifically, because there's so much work to be done just adding this very good layer that these big companies are moving very slowly about, right? So and I think once you do that, that really gives you a leverage multiplier effect for distribution, where you don't need this kind of agent model, right? Lastly, I think the most critical part, which I would listen to and understand people's criticisms of Insurtech, would be regulation. Will digital insurance licenses follow digital banking licenses? And like Andrew mentioned last episode, they are rolling out digital banking license end of this year. The question is, how will the national banks start looking at insurance licenses as well? Because most of the regional players who are embedded entrenched, they got those licenses decades and decades ago, have been able to build monopolies. So the question is, will they be distributing for more newer, innovative players? And I think, that's going to be the question. Will it be a big TAM, or still going to be very fragmented? And if you want to be a regional player, how do you go about doing that? Do you go about doing it with partnering with other people with licenses then? Is it possible to get your own license? So essentially, the way I look at it, a tech layer will widen the funnel and create the stickiness in this old industry. And I am quite bullish on the space. If you have someone who's a domain expert who can navigate the regulations in their own market, and then eventually think about how to do regional expansion in other categories. And the way I would do it is very bottom up, create the value and the stickiness in the product first, build a brand moat around that. And then after that, it starts to make sense looking at other categories once you have a very profitable niche. And I don't know what happened with CXA, but like if you're doing insurance, you don't need many premiums. You need like a few thousand premiums just to be profitable in itself. Right. And so what happened with Oyen is that, within the first months of launching, they were able to sell more policies than the product owner had done in the past few years. So there's so much room to grow and innovate here. And that's my take on it. So what do you guys think about Insurtech? I know Jangan and Andrew have a lot to say, maybe some criticisms or maybe some insights.
I think I'll let
No,
Andrew say
I
first.
want to hear you, Jangan.
Go for
The
it,
guy
Andrew.
with your crystal ball.
Because he's older than us, right? So he goes first.
In Asian societies, we give respect to our elders. Please, Jangan, tell us your views.
Okay, I'm 3 years older than you, which means that I go home at 10:30 after parties.
You
instead
party?
of 12.
Of course he parties. Jangan parties, dude.
Oh wow, Jangan, I gotta see this.
Now it fits very nicely with the government policy here, which stops any establishment from selling alcohol at 10:30. So it just very nicely fit.
Perfect for yes, I agree.
Yep. I don't remember who wrote that CX article on our blog. I mean, so basically the blog
That was harsh, man.
It's a team effort, right? So some members of the team said, okay, I have a topic I want to talk about, and they just write it. Sometimes we discuss, because some of the topics that the other team members might know deeper inside stories. So that we said, okay, maybe it's too harsh on or whatever. So CXA is an interesting story, right? It sort of started by these benefits and whatever, and but essentially it's a brokerage business. It has a SaaS business, but it's fairly small. What I found interesting was first is their cost structure, and I think they were burning about $3 million per month in Singapore alone. They have like 250 Whoa. Or I don't know, I can't remember the headcount, but very, very big headcount in Singapore. So that part was burning lots of money, and of course the growth trajectory in this region was not as fast as the founder and investors initially hoped. Interestingly, they had a business in China. I think they still do have a business in China. I'm not sure if I've sold it recently, but that business was going well because you have lots of MNCs in China, which basically do not trust local brokers. So they managed to sell into that market, and it was doing really, really well. But headquarters, the cost was super high. And I was talking to one investor who was complaining that the whole team went to Maldives for the annual party, and for a very, very long time they didn't have a CFO. So I think one of the sort of complaints from investors is that for a founder who's experienced, I think it's just like late 50s, early 60s or something like that. So very experienced, should not have made this fundamental mistake of managing cash flow. Maybe the founder was too optimistic, as many of the young founders would be, but that mistake was not for the type of someone who's very experienced in a corporate setting. And I I think some friends around me sort of group her in the same category as Chattery of One Championship.
Ooh,
Because they always go and tell their childhood stories. I grew up
that's
in
true.
in a
Yeah.
poor neighborhood, tough childhood, and etc. 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 Then this is how I met myself. Very inspiring, but I think many people around me have grown quite skeptical about this kind of stories, especially when they are told by the founder themselves. I mean, if it's told by other parties, like some of the politicians would do, and that will probably make it more convincing. But for the business model per se, I, th- I think we have team members who are very experienced in insurance, with regulator and manufacturer experience. We're doing some consulting projects on Insurtech as well. The business has huge potential. I mean, if you look across the region, the insurance penetration, you can see the numbers. I mean, we talk about life, where there's like 3%, 5% in large countries like Vietnam, Indonesia, it's very small. So there's huge room for growth. And lots of the general insurance products are not sort of proliferated. Many people do not have insurance for many things. So definitely the potential is huge. Now the question is that how do you tap into the market to build a business model that's attractive and that's also sustainable? So if you look at many of the models being built are essentially, three parts, right? I mean, first is the marketplaces. I mean, the ones which aggregate demand and
Products.
yeah. So basically, you put products from different insurance companies, and people can come and pick and choose, and really good search or whatever. So this is one business model, and I think many of the prominent insurance tech startups which have raised money are in that category. And the second is this part of the ecosystem, right? I mean, so if you look at some of the products rolled out by Grab, for example, so I think for the drivers, they get health insurance on a per trip basis, which many of the drivers didn't have insurance in the first place. So these are typically done by manufacturers directly or by the ecosystem. And the second is, and also the third is what Wei Zhu, the former CTO of Grab, has been doing, which is kind of like a how would I describe his business? He started as a Zhong'an copycat. Zhong'an is a business in China which was co-founded by Jack Ma, Pony Ma, and Minzhe Ma, the three Mars, which
Ma.
yeah, Ma, yes. And
Yeah.
they were at the helms of companies like Alibaba, Tencent, and Ping An. And Zhong'an initially started with selling lots of different insurance products, micro insurance products, on these platforms because they have huge distribution, they have captive audience.
Yeah.
But somehow, I mean, for whatever reason, I haven't investigated in detail yet, but that business model didn't quite work out for them. So they have transitioned into more of a B2B player to help insurance companies build systems. And I do know a few customers of them. They're very, very good words about them. So basically very flexible, very experienced, and very fast. So Wei has this business model. I think he has raised a bit of money, and he's helping sort of insurance companies solve the technical problems, distribution and underwriting, and basically creating this layer that everybody can tap into. How that will work out in the competition of Zhong'an in Southeast Asia and a few other companies, we will have to see.
Yeah, I have one comment about something that you said, and I think this came out of my conversation with Kevin yesterday. Is that if you really want to look at if you're building or if investing in the space, another way to look at it is that how many big insurance companies have been innovating on the products, like how many new products are they innovating or launching every year? And you will see that it hasn't changed at all pretty much for the year. So there's so much room to use data, use we're not even talking deep tech, just very basic things to find out what market's being underserved and how could you innovate or even change the existing products itself, right? So there's so much room for that. Of course, the challenge of that is you need to be working with someone who has the license and the underwriting capabilities, which is a little bit trickier, right? But of course, I think a few companies that we know have probably done this. Even the more infamous ones like Nova, they partnered with the right institutions and they had be able to get the right financiers from China and stuff. But so there are possibilities, I think, to do that. But just really just look at the products and what's coming out of these companies, and that's the lunch that you could take from them.
Yeah, I think insurance companies are struggling to innovate as well, right? I mean, so for instance, FWD, which is
Yeah.
going for IPO, they have been trying to innovate, but historically the problem is that we try to build an insurance business. I mean, you have all these legacy functions which you need to put in, and for these functions, you can only hire people from the industry, and of course we hire like 150 people from the industry. They bring a baggage.
Yeah.
They will tell you that okay, this can't
Yeah.
be done, that can't be done, etc., etc.
Yeah.
It's very difficult from building a pure tech business where people just try and error.
Yeah.
So that's a challenge. And the second point is that when you try to work with insurance companies, what exactly is the pain point? The pain point is that they are slow, or what?
Wait, work. You mean as which party working with, the customer or what?
You mentioned that new platforms have to work with whoever who has the license, and I thought that's a rational approach, right? Because for you to test the system and for it to work, for it to get traction, to get money, and you don't want to spend your initial capital to acquire a license.
Yeah, but typically, in order to do that, you have to be a domain expert. So when you look at the founding team, it really helps that they've done the business with their family business, or they've just been in insurance for a long time. They know all the CEOs. You really the sales cycles are very different. It's very clicky across the region, and the few regional players, and when I say regional, it's typically 2 or 3 countries, because it's hard to really entrench yourself in other markets outside your own home territory. So that's the kind of like expertise you would need. Yeah.
Cool. Yeah, I mean,
Andrew?
lots to say here. I'm super bullish about this this whole segment, right? Like, first of all, okay, before we even start, shout out to the 2 companies that got Series A's in this last month in Southeast Asia. Polystry Street with like 8 or 9 million USD, I don't know. So Winnie's team, awesome, well done. Yeah,
25 million
brilliant
ringgit.
stuff. I think LifePal did 9 million in Indonesia in this last month, so it's definitely heating up. At least in the Series A space, and more to come, right? I think
quickly though, you should give a shout out to the local investor, Masing Group, a Malaysian like family business. It's their first investment.
No. Masing's team has a little VC team going on. They've actually made a couple of investments. Yeah. No, the kids are definitely looking at finding ways to invest family money in tech, which is pretty cool. I think that's happening across the region. A topic for another podcast. But yeah, so back to this. So I think, one step back, insurance is one of those areas where I think you can actually hit the Venn diagram of making a positive benefit in the world and making a ton of money, right? It's one of the few industries where you can have 100+% of margins. And number 2 is like, if you think about, a lot of people who want to get healthcare just can't afford it. A lot of people who, in some countries where car insurance, for example, is not mandated, like Indonesia, if you total your car, you're basically screwed, right? You just have to figure out how to get yourself a new car. And so, no, it's not mandated in Indonesia.
Is it not mandated?
It's crazy.
Really?
It is crazy.
That's crazy.
And it's one of the really hard reasons for why some of these startups are struggling, because if it's not mandated, how do you even sell to people, right? But so the point that I'm trying to make is like, I think if you provide insurance, you make a ton of money, and you also are able to protect people and save people cash and help them have better lives, right? So if you do it right, game changer. Now, in terms of like innovation, let's be honest, like the insurance product hasn't changed. You figure out a probability density function for certain use cases, you figure out how much to price that, and then you give it to people, right? Now, so there's really 2 places to innovate. The first is product innovation, which is either, and product innovation specifically means 2 things. One, you make the premiums cheaper by using better data, right? Or 2, you start to target an ignored segment. So let me explain what those means. Like, making it cheaper with data means in the past you didn't have data, therefore you had to price an average across a big group. Now with data, you get to price a small group. So examples of that: Root in the US. You have a telemetry device in your car, or now you can even use your smartphone. That telemetry device records the speed of your car, your driving style, etc., compares it to a group of people, and then your premiums get reduced if you're a safe driver. Because if you're a safe driver, why should you pay as much as everyone else? So that's really fucking smart, because now if you're a safe driver, you're incentivized to be safer and then pay lower premiums, and therefore you reduce and save money, right? I think
Can I give a quick shout out that that is a real pain point for Southeast Asia. I know a lot of big like asset heavy car rental companies who are they in dire, they need this telemetric type of information to be built into the insurance models to lower the premiums, and that would be a
Yeah,
huge thing
I mean,
to
and
tackle if
also like
anyone's
think about
interested.
it. If you're doing it for car rental companies, you can, with verified credentials, you can pass on information from an individual, which is also like a white space, right? Because now they don't know who's driving, so they've got to buy group insurance for the whole rental car, as opposed to adjusting rates by people. Yeah, so crazy ideas, but very cool.
Yeah.
But that's just the beginning, right? Like there is an old school traditional insurance company in Singapore, I forget which one, who's using smart watch or smart band data to reduce your health premium. So if you work out, if you have an active lifestyle, you actually reduce your health premiums, which is incredible. So you get to use all these new data sources to. I mean, David Friedberg's company, Weather Bill, was based off this.
Not
Sorry,
not good for Dave.
not good for Dave. Yeah, which
Not
Dave?
good for
Dave
Dave.
Chang? Dave.
He just had Chipotle for
Yeah,
dinner or lunch.
maybe
Well,
Chipotle can
Chipotle for
subsidize your.
dinner.
I'm in
Yeah.
great shape.
No worries.
Sorry,
No
Andrew.
worries. Minnesota food's really getting to you, Dave. That's awesome. Um, so, and like I can't remember what I was saying. So smartwatch data improving health outcomes, and there's also like just then the second piece is like completely ignored segments, which can sometimes come from the same piece. So if you look at like Weather Bill or the Climate Corporation, like David Friedberg's company, it's basically insurance. They figured out that hey, rain affects enough businesses. If we can find a way to monetize rain, then we can make some money. And they realized, hey, actually, agricultural producers are very affected by climate change and the change of seasons. Let's find a way to ensure that. And then they got into this whole space of like agricultural insurance and did way better than anyone else using data, right? So that's like, yeah,
Yeah, and there's no one looking at that in the region from
there is,
like a
there
climate
is.
change perspective for Southeast Asia, right? That's probably
Yeah.
huge. There
So
is?
so so
No.
this space is heating up like mad in Southeast Asia. So the first piece is like, product innovation. Now, it's not as important yet because there's a bigger problem to be solved with insurance. And that's why you're not seeing product innovation happening at a fast pace in emerging markets yet, right? Because distribution hasn't been cracked. As long as insurance rates are low, it means like solve distribution first before you're doing all the funky stuff, right? So, what do I mean by that?
Mm.
There's really only three ways to sell insurance, right? The first is you get an agent, and that agent goes out and sells it for you. The second is you try to create some kind of a direct central repository where they buy it from. And the third is you sell it in tandem with another
Yeah.
product. That's what's called associate sales, right? Now, surprisingly, what's happening
Yeah.
in Southeast Asia is D2C. Everyone who's starting out saying they can do D2C ends up doing associate sales, right? What do I mean by that?
Mm.
Because D2C is hard, right? Like if you think about insurance, no one looks for insurance. Like insurance is something you think about when shit happens to you, and especially if you're trying to create something new, like say, oh, telemetric data car, or like agricultural climate science affecting your crops. If you're a smallholder farmer in Indonesia, you're like, dude, I have enough shit to pay, right? My kids don't even go to school yet. Can you please calm down on this stuff, right? The bigger corporations get insured, right? And so there's like a B2B space that can be done, but then like with smallholders, which is the majority of Southeast Asia, that's really hard. And so like I like this insurance space is huge. So cracking the distribution cycle is tough, right? So what is the associate sales model? So let's look at Indonesia, for example. You've got, Pasar Polis, which is pretty much built off Policy Bazaar in Indonesia. Or in Malaysia, you've got Policy Street. You've got Senang Insurance that's trying to do the same stuff. Basically, this idea that you can create a massive platform, have everybody's insurance, and then you sell that, like basically a marketplace of insurance. Fundamental issue with these is nobody looks for insurance, right? So it's not like e-commerce where someone thinks about a phone and then comes to your site. Insurance, like you actually have to actively create intent, which takes a lot of money, which means your CAC is really high. Um, and so that's why a lot of them end up doing associate sales. And how do they do that? So if you look at Kuala in Indonesia, they've got a very successful model of selling on the back end of products. So if you buy a bus ticket on any platform in Malaysia, catch that bus, red bus, there's a little like 20 cents additional that you pay to insure yourself on a bus journey. That's provided by Kuala, right? So they just ended up pivoting to this model where they do associate sales. And it's incredible because like it's a zero friction product. Like as soon as people buy a ticket, they're like, oh sure, yeah, you need to opt out, right? And so Grab, for example, is moving quite heavily into this space. You have like 3 or 4 companies in the region that are trying to just build out an associate sales model, right? Which is really really smart if you think about it, right? And then you have this other evolution, which is a lot of guys that end up doing D2C end up just getting agents to become a part of the business, and you wonder why. Like, why you were competing with agents, now you're getting to this. And this is where you enter fundamental issue number 2 with insurance, which is insurance providers have been working with agents for the last century, and they are afraid to piss off their agents, right? And so as a result, the best products are reserved for these massive structures of agents, like they're almost pyramid structures of agents that are able to effectively execute and sell. So why do you hurt a distribution channel that works effectively by suddenly killing them off? Because there's no real added benefits. And if you think about insurance, it's a pretty expensive product, so you need that human touch of selling them. They've effectively outsourced salesmanship in this very incentivized system that's been working for multiple years, right? This assumption that D2C can work is actually really, really hard. So what does this mean for the industry? I think you'll find new people. Like, so with CXA, like, call out to CXA since we just started with them, right? What they tried to do was a combination of like associate sales and D2C, right? So they went to companies and they said, how else can we sell group insurance? Because group insurance is commoditized. Everybody knows how to sell group employee insurance, right? So they were like, what if we bundle perks and employee health with insurance, right? Could we give you ways to use the gym, get all kinds of cool perks? And it was a pretty interesting business model. The problem is at some point price becomes competitive and nobody wants to pay the additional to get all these cool perks, right? So it's a pretty tough business model, and it arguably isn't as innovative. Like, you're not really cheapening things. So the problem is, like, if you're not making it cheaper, can you really succeed? Super tough, because at the end of the day, what people really care about insurance is it cheap enough? So, like, what do I think is going to happen next 5 years? You're going to have more and more of these insurance players that are right now doing their own thing start to integrate deeper, right? So Pasapolis, for example, is integrating deeper into Gojek. I think Gojek invested in them, and now they're pretty much the sole provider of,
Yeah.
of insurance to all of the customers on Gojek's platform. So it's Gojek's big insurance play. GFG is doing their own internal insurance thing, and they'll possibly have a couple of M&As and acquisitions. So I expect some of the Southeast Asian startups to get acquired by these big players. But the second piece is, I think product innovation is going to pick up. So like Alex is invested in a company that's kind of, creating a whole new segment, pets, because no one cared about this in the past. Like, insurers were like, yeah, it's big, but not bothered. So if somebody's willing to take on that risk, they just need to create the internal actuary table and then sell the product, right? The problem is distribution is not defensible and the margins are nowhere as close as good, right? If you're actually doing insurance, that's where the margins really are at. And so at the end of the day, the big insurers are the ones that win, and the reinsurers behind them, right? I don't know if the startups are really winning so
Yeah,
much.
correct.
But yeah,
Yeah.
that was a big spiel from me. So let's hear it from you guys.
Yeah, I mean, the holy grail is to get a license eventually. And that's I think what people will be looking at too. If you want a real moat
Yeah,
for,
but that
for the
risk
region
is
in
rough,
this.
huh?
If you talk to the insurers in the region, and everybody will tell you that that eventually they want to do life, right? I mean, general insurance is competitive. I mean, motor insurance, etc. Eventually, you will become a race to the bottom very, very quickly. But if you do life insurance, first, I mean, the premiums are high, so which means that also things you can do with that money. And second is that people are locked in for a very long time. So, so I think what Andrew mentioned about agents, right? I mean, agents function very well in life insurance, function very, very well in large corporate and business insurance. So because these products are complex, and it's very difficult for people to just do a self-discovery and make a purchase decision without somebody explaining to them how it works, right? So I do know a few life insurance companies trying to go direct, and the uptake is always very, very low because people just don't understand the product. And of course, partially it's because the marketing folks and the product folks at the insurance companies are trained to make the products safe to explain, which means difficult for people to understand. Your point about Passapolis, etc. I think this is in line with what I mentioned about part of the ecosystem, right? I mean, you have the marketplaces which try to eventually become a manufacturer themselves, but you also have the companies which are affiliated to a large ecosystem, which they can sell what you call associated policies. So essentially, if you get yourself plugged into a ecosystem, I mean, with Grab, with Gojek, with Shopee, for example, I mean, there's a lot of insurance policies you can sell. My little issue with that is I mean, of course, I mean, for a company to grow, no problem, but eventually you will become like JNT or I mean, the companies which serve the large platforms. That I mean, how much margin you can capture, and by doing things which are specific, by doing things which you have to depend on other people's traffic. So if the platforms become dominant, I mean, you can survive and you can probably make good money, but your lifeline would be dependent on the platform. So really, it's up to you how you can make yourself sort of more relevant in the future. As for marketplaces, I think pure marketplaces, you have seen lots of examples of them trying to just aggregate demand for insurance and other financial products. In Southeast Asia, I mean, Singapore, you have few failures, and people can't get the economics to work. But what I've seen in China is that I mean, they will eventually face a difficult time because as the market becomes more competitive, the customer acquisition cost would go up, and precisely as Andrew said, right, nobody would actually go and actively look for insurance. Nobody would have app or insurance and check their policies every day. So how do you acquire customers and retain the customers when the cost of acquisition keeps going high? So I think one company might have cracked that, but I think the capital market doesn't really believe that yet. Is a company called Shuidi or Waterdrop, which is US listed. So this company started with a very interesting model. I mean, there's comparable called Kitabisa, but I think the mentality is very different in Indonesia. But what this company did is it started as a crowdfunding platform. So if they say that, okay, I know someone who is seriously ill and he's not adequately insured, I would go and share on WeChat saying that, hey, this person needs help. I can vouch for this person. Whoever who wants to chip in 5 yuan, 10 yuan, please go ahead. So that is a way allowing them to acquire lots of customers basically at zero cost. But that's also thanks to the WeChat platform, which allows you to publicize as well as to collect payment. So that's the first stage they did. The second stage is they're telling all these users which they have recently acquired, saying that, hey, do you want to put 5 yuan in a pool so that, I mean, if somebody gets sick from all these policyholders, not policyholders because they were not insured yet, but if anybody gets sick and we can dispense this money, so that becomes mutual insurance basically, and that model which has been existing in one form or another in all the traditional societies for a long time. So yeah, that allowed them to convert many of these casual users into sort of captured users. And then the next step is that they are trying to upsell these guys policies from insurance companies, and even afterwards I think now they have insurance license themselves, but I think the team has been sort of thinking about, I mean, when the customer acquisition cost goes up, how do they make this business model sustainable? I have a friend who just did a tour in China to talk to all the Insurtech companies. She represents an insurance company, and she was amazed at how Waterdrop sort of delineate, I mean, sort of compartmentize different user groups and try to upsell them different things. And she said they have built this technological sophistication, this way of analyzing data and segmenting the customers that no other marketplaces have done. So theoretically, they can keep this advantage. It's like 1 year, 1.5 year advantage over others who can acquire customers cheap. So that might make them more sustainable. But also, of course, because they now have a insurance license, which means that they can do the manufacturing work. So it's still interesting dynamics, and probably something that some of the Insurtech companies, especially the marketplaces here, can think about and maybe learn from.
Yeah, I mean that just goes back to my first 3 points, right? Looking at the customers and innovating, and I think it's just applying startup principles and better data, better technology, which hasn't been done, and then cracking distribution. So, final comment, Dave. Do you have to go now, or?
No, I have some comments, but it's kind of related to buy now, pay later. So maybe we just move on to that.
Okay,
And then
let's
I'll do
Okay.
that, and I'll fuck
We'll
off.
move to buy now, pay later because Dave has to rush off. He actually has real work to do. He's acquiring a movie studio. So
More lies. All lies, Alex.
okay, so buy now, pay later. 3 days ago, MasterCard launched a buy now, pay later feature. They seem to be a little late in the game. Things are really heating up on that side of the world. Amazon backs an Indian company called Capital Float, invested 50 million, which is also a buy now, pay later. They've acquired 2.5 million users, which is 4x growth in the past 12 months. I have personally taken calls from a bulge bracket bank looking to use their financial infrastructure and balance sheet to fund these types of user-based opportunities. So it's a really interesting space to be in. Everyone's looking ways to monetize these user bases. How is this unfolding for Southeast Asia? Dave, why don't you start since you...
No, it was Alex. It was Alex.
Yeah, I think the problem was Alex.
Oh, okay. I thought it was me.
Maybe you should check. You should check
Alex?
if my partner is in your house, Alex.
Yeah. Amy, get out. Okay, but I don't know. What did you guys miss?
Everything. Everything.
No, I think we got most. I think we got
I
most.
heard
Yeah,
buy,
just the last
pay
scenario
later.
or something.
Okay. Well,
Buy now, pay now.
Yeah. So essentially,
Buy now, pay now.
That's a great alternative.
That's the new innovation. My new process is buy now,
That
pay
should be
now.
your next startup.
okay. The crux of it is these old institutional players, these monopolies are getting into it, right? And then we have these newer players from Silicon Valley who are kind of displacing monopolies, right? So, what is your take on how this unfolds for Southeast Asia? In what direction does this go? Is this a feature in a payment stack? Is this going to be companies in themselves that become financial institutions themselves, or what does this look like?
So I have a couple thoughts about this. I mean, I think as everyone knows, like buy now, pay later is by no means a new innovation. This has been around since like 2005 or something, right? And actually, it's interesting we talk about that. Did you notice that Stripe acquired Afterpay earlier this year? They spent like I think like
35.
Yeah.
30 billion US dollars to acquire Afterpay. And then basically the market cap increased by 35
free acquisition.
billion US dollars that same day.
Synergy is right there.
They liked it. The markets liked it.
Yeah. So I think, I think that's like a really indicative event, right? We kind of joke about it, but seriously, right? Like that made sense because essentially what the market is saying that the sum of the parts are greater than the components individually, right? And that's sort of like my stance on buy now, pay later in the region, is that these are essentially these are features. Then I mean, if you think about these businesses, right, they're not really innovative in terms of the technology. They're easily replicable. And in the region where we're talking about e-commerce is actually fairly consolidated. Not fairly, but it's more consolidated here than it would be in a market in the West, right? We have a couple of big players in each market. You have your Shopee, you have your Lazada, you have your Bukalapak, and you have your, maybe like a Goda if we're talking about travel, if we're talking about like the non-physical item related verticals. Right. So essentially what you're saying, what we're talking about is like the way that these businesses acquire customers is sort of, to John Gonn's previous point, it's basically off the back of other people's traffic, right? So you can only grow a business so much in that framework. How this like relates to sort of like the fintech stack in general, I think is actually, I had a thought, is like, if you think about sort of like consumer financial products, right? There's really kind of like 4 categorizations that you can put these into. There's banking, there's lending, there's insurance, which we just talked about, and then there's trading, right? And if you sort of rank these things in terms of like which ones have the highest retention, banking's at the top, right? You like almost never switch your bank unless you move to a different country. Move to your kid, you'll put a bank account, you keep your bank account forever. And then if you sort of like move down the stack, I think the one that probably is changed most often is probably either going to be trading or insurance, right? Those sort of have the lowest retention. But on the flip side of that, if you look at these financial services in terms of like a profit perspective, banking has the lowest profit. I mean, banking, like an actual banking service, the bank makes almost no money on. They get you on other things, right? On the flip side of that, if you look at the financial services that have the most profit, it's going to be probably trading or insurance, right? So to me, what this sort of says is there's an angle where you could essentially have not commoditization, what I'm going so for, aggregation in the fintech stack. So it's what's similar to what's happening in media, right? So basically, you pick a vector in which you want to approach consumer financial products. Usually, banking is probably the most popular one that I've seen, where people offer free bank accounts, online bank accounts to these challenger banks, and then they layer on top of that the more profitable products. So your insurance, your trading, and your lending, right? And so that sort of kind of goes back into sort of what we're talking about here, or sort of the framework or nature of our conversations over the last couple of months is like we have all these big tech companies that have raised huge quantities of capital, venture capital, and how do we deploy them, right? I think they're all taking different approaches, and this is probably the more I understand about it, the more I think about it, this is probably their end goal. They want to commoditize the entire fintech stack, and they're all just choosing their most relevant or easily picked vector to get in.
Andrew?
No, Jangan, go for it. I see that you're writing vigorously, Jangan. I want to hear everything you.
Yeah, you're taking
I'm
notes.
writing vigorously. First, we are going to launch a report about new bank experiences. I can send you guys a copy before it's going public. Exactly in line with what Dave said, right? I mean, you basically build a basic product, identify a niche, and you provide a good product which includes customer experience, etc., and you accumulate customers very quickly. Then you try to upsell them into something more lucrative or more profitable, or sort of that helps you with customer retention as well. So that's the first point that I want to make, which is not really buy now pay later, but I think buy now pay later per se.
I was expecting you to say you're launching a buy now pay later for your subscription model.
No, it's a buy now pay now model.
Buy now, pay now for this report.
I might launch a prepaid model, which from cash flow point of view is probably even better. But very interesting. So between 2017 to 2019, one of the ventures we did in Indonesia was a fintech venture, and one of the shareholders was the first product director of Huawei, which is essentially the buy now pay later product of Ant. So over the course of 2 years, we learned a lot from him and his team about how this works. I think it essentially still goes back to the same point, right? You build that off the back of large ecosystem. That's what allows you to have the richness of data for you to not necessarily for you to credit score or whatever, but have richness of data which should allow you to adjust the model to reach the optimal point where you balance profitability as well as growth. Coming back to buy now pay later in Southeast Asia, I mean, it's getting hard probably because global investors are very keen on that. I mean, all the stories with Affirm, with Afterpay, etc. But companies have been trying to build buy now pay later products in the region for a while. I mean, if you look at Indonesia, Kredivo and Akulaku started about the same time. Hello.
Why does he have your dog?
She didn't come home last night. She's a terrible child.
Oh, I thought it was a lamb.
Oh, yeah, she does.
It's a bitty bitty.
It looked like a lamb.
I am goreng. Yeah.
Say hi to Alex. Look, dude, it's Alex. It's your other dad.
Okay.
Oh no, I have headphones on.
Continue, Jangan.
Yeah, sorry, Jagan.
Hey, no worries. So if you think about Akulaku and Kredivo, they started doing buy now pay later a long time ago, and of course some people are arguing that wait, this is the same as credit card installment, but it's not the same as credit card installment, because you are creating something which targets sometimes very small ticket items. And you are targeting the masses of the market, and your credit assessment and your approval speed, etc., everything is super different. So from probably money flow point of view, it's very similar, but from the mentality of the business point of view is quite different. So this company started in 2016, 2017. And initially, I think everybody wanted to do that off the back of e-commerce rise, right? I mean, I think Kredivo in the very beginning plugged into a number of e-commerce platforms, and Akulaku went to a different route because they realized that was too slow. So they went to create their own e-commerce platform, and they were selling phones using their own sort of buy now pay later products, cash installment, etc. So So fast forward a few years, and these companies are all trying to become financial ecosystems. I mean, they're going into cash lending, they're going into insurance, etc., etc. And then you see the whole explosion of buy now pay later in the region, right? Advanced Intelligence Group, which owns Advanced AI, as well as Credit Pintard, as well as Atome, which is their buy now pay later bet, has just raised, I think, $400 million at a valuation of $2 billion. Etc. etc. And in Singapore, you do have a few players being created. The interesting part is that if you look at Singapore, Australia, and all the sort of mature markets, the dynamics are very different compared to markets like Indonesia, for example, markets like Thailand. In mature markets, first, as they've said, you don't have the dominance of large platforms. There's a strong and big long tail. So theoretically, you can pick up lots of merchants, lots of Shopify stores, and lots of offline chains, and make a viable business. This is relatively harder in emerging markets. Because all these guys try to do it on their own, and also the e-commerce platforms have probably disproportionate power in the whole ecosystem. So at the end of the day, how this exactly work out? I do think that that it's a game that's not super hard to play, and as long as people get their mind around it, even for the banks, I know some of the banks have been trying to explore that. It's not that they don't understand the product. It's not that they don't understand the mechanics behind it. It's not that they can't find the people to run it. It's how to get their, various teams around it to see that, okay, whether this is a product that from risk point of view, they're comfortable with it, because their cost structure is different. But I think with companies like Grab, companies like Gojek, Tokopedia, especially e-commerce companies, Shopee, etc., when they go into buy now pay later, it's quite likely that the other products that's based on their system will be, I wouldn't say marginalized, but they will try to keep the most lucrative segments to themselves, and transfer the risk to other players as much as possible. They're not there yet. I've spoken with people who have, from different platforms, who have been using Uncredible, and everybody tries to, or wants to cut them off, but everybody can't, because they said, for whatever reason, Credivo's customers are just very loyal. So if we cut them now, we lose these customers. But it doesn't mean that they're not trying, and eventually this will become some dynamics that I think Credivo will, and the likes of that, will try very, very hard to build themselves into a fully functional financial ecosystem, so that they can better retain the customers.
I just want to add a quick point to what you said, Junggang, because I think it's super interesting, right? I think you're right. I think all the big players are going to try and roll out this feature on their own at a certain point. And I think actually a really good indicator of who is going to be the leader or the dominant player is the one that does it most successfully, right? Because there's like this famous adage or heuristic where basically the markets reward companies that can take cost centers and turn them into revenue centers or into profit centers, right? And those are going to be the ultimate winners or the long-term winners in this game. So I think whoever can pull that trick out first and do it most consistently, that's the guys that you should be betting on, or we should be betting on, whoever wants to bet on.
What's the cost center in this reference? Like, it's a revenue center, no? Like, why would you need to flip it?
Your payments infrastructure. No, because buy now, pay later, your payment costs, right? Because buy now, pay later, how it works is the merchant actually pays a percentage of the transaction fee to the buy now, pay later company, because theoretically the buy now, pay later guys are bringing you more customers. So it depends on the platform, but it's somewhere between like 4 to 5%. And then obviously these companies also make money if you as a customer don't pay, and then you get hit with interest charges. But the majority of the money comes from merchant fees.
Correct. So when you say flipping the cost, you mean the merchant flipping the cost into a revenue center?
Yeah. So if I'm like Lazada, right, and I have sorry, go ahead.
Yeah.
Sorry. I think you just said if I'm Lazada, Lazada is the merchant. But anyway, so.
Yeah, if I'm Lazada, Lazada's the merchant. So if I'm using a third party buy now, pay later, that's my cost center, because I'm paying 5% commission to whoever that is, right? But if I develop my own,
yeah, absolutely. I'll tell you though. So internally, like okay, like the Lazada, buy now pay later is sexy, but the problem is there is a certain amount of risk associated with it, right? So that's why Shopee, for example, has launched Shopee Pay, which is like one of the fastest growing products. But I can tell you there was a big internal debate whether to do this or not. For the longest time, the biggest player in Southeast Asia was FinExcel's Credivo. And Credivo basically undertook a lot of that risk, which meant most e-commerce players didn't want to get into this space. This space really heated up for two reasons, right? One is so most credit cards already provide some kind of 0% installment plan, and actually that works quite well for high ticket items. So in Malaysia, for example, we work together with 3 banks to get 0% installments onto Lazada, and we negotiated to have up to 36 months of installment, which is freaking incredible if you think about it, right? So if you buy a TV that costs $600, 2,000 ringgit, you can divide that into 36 payments of less than $50 each, right? No, less than what, $12 each, right? So it's pretty incredible that you can take a big ticket item. The problem is with these kinds of 24-month, 36 months, typically what retailers do is instead of 0% EPP, you try to split that percentage that you pay to the bank, which has some element of risk underwritten into it between the consumer and the merchant. So the merchant is willing to pay because I otherwise would not sell to that customer. And then the customer is willing to pay because he otherwise wouldn't be able to divide those payments into that many installments, right? So that market has existed for a long time. There's two issues here. Number one is that market exists for people who have credit cards, right? And typically in Southeast Asia, it's people who earn more than 1,000 USD per month, depending on the market, which is a pretty high barrier because most people don't have that kind of money, right? Which means, in effect, most people who earn below that, just what we call the underbanked or the under credit served, just don't have any access to some kind of credit product, right? BNPL, so BNPL from a very global standpoint is able to basically tackle this group of customers globally, right? So Klarna, Afterpay are tackling people who may have credit cards, but also just wouldn't mind having 2-3 simple, easy payments. And actually, if you look at the numbers, most people who use these services end up not paying late fees at all because they end up paying on time. So in that sense, it's a weird model, right? But merchants love it because you're getting more customers, and customers now can divide a £300 purchase into 4 small payments of less than £100 each. So it psychologically becomes lower. Personally, I hate this whole space, right? For 2 reasons. I think it's a great business model, but it just encourages rampant consumerism, right? So as a hippie who likes spending time in the jungle now, I hate the idea that you take already small ticket items, you make them even smaller tickets so that people buy more useless. Like what's that line from Fight Club? Advertising has people working jobs they hate to buy shit they don't need, right? And so BNPL is just another gear in that system that makes people just buy more stuff that they don't really need, right? Now, if you could use it for the problem is, and it's really like if you look at Klarna and Afterpay, it's like £100. That's like their typical price range. So these aren't even big ticket items, right? They're very small ticket items that people just divide into 3 payments because instead of buying one thing in March, now I get to buy 5 things because I can use Afterpay or Klarna, right? And so they end up just buying 5 things every month and just racking on debt. What I don't like about this second thing is it actually normalizes debt. A lot of people who actually shouldn't be getting debt because they couldn't get good credit scores or they're just not used to paying debt. Like think of your 18-year-old kid, right? You want to buy all kinds of things. You're a sneakerhead, you love sneakers. Now you end up buying 5 sneakers, right? And the problem is once you miss late payments on any of these apps, it actually does affect your credit score. So you may be making silly decisions at 19 that affect you when you're 29 and trying to buy a house or buy a car, right? So I do think I'm not sure about buy now pay later's benefit to society because it doesn't seem to be affecting people buying things that actually have some kind of positive utility. I'm not sure where China stands on this, Jiang, and I'd love to hear whether this also fits within Xi Jinping's spiritual opium, or it's a different kind of opium. But the point is this thing, the business is great. You're going to make a ton of money doing it, no matter how you cut it, right? Whether or not you charge late fees, but I don't think it's a great business.
Buy now, pay later promotes rampant consumerism, says the guy who built out one of Southeast Asia's largest e-commerce platforms.
And then left when he decided he was, had enough of building
Yeah.
consumers. Now he spends his
jungle.
time in the
Okay.
forest.
Sorry, Jang, go ahead.
That's right.
Um, I don't know. I mean, if some product which makes it easier for people to buy things, I don't think that it should be up to the capital to rein themselves. I mean, it's up to the regulators to say that, okay, where's the boundary, right? Because I mean, it's very, very hard for industry to self-regulate without some clear rules, and especially especially when you have competition. So when you self-regulate yourself, I mean, the other parties will race ahead. So that's a problem. By now, Predator specific per se, what I learned is that, I mean, the Huawei product of Ant, and is actually one of the reasons that got Xi really pissed off last year, because they said, okay, young people are taking too much debt. But the truth is, Alibaba does, Ant Group does not really make money from Huawei, and I've seen the numbers is largely breaking even. But what's interesting is that I mean, precisely as Dave said, that I mean, if you pay late, and you have a penalty, right? So they have translated this penalty into another product called JB. So say that if I can't pay back my credit on time, they will offer you a loan. I mean, this is the same as the bank's credit card refinancing.
What?
This is predatory lending.
No,
is what this is.
What?
Instead of, I mean, banks will tell you that instead of paying 26% interest on your credit card, how about I offer you an installment loan which only charges you 11%? That's
How meta,
much
man. It's crazy.
that's much easier to sell than calling you in the first place to offer you a 7% loan for money you don't need, right? But anyway, so that's something which really pissed the government off, and especially they look at the debt ratio of young people. But that also translates into a problem, is that how should regulators deal with it, right? Because you can't rely on the industry to regulate themselves, and especially in a competitive environment. So for a long time, Singapore has this rule that first, I mean, for any lending product, any credit card product from the banks and financial institutions, you have to declare the effective interest rate, not the headline interest rate. Yeah. The second thing is that, I mean, people's unsecured credit is capped at I think 2 months of your monthly income. The curious thing is that buy now, pay later, because the classification is not exactly clear to the regulators, and is not part of this. So theoretically, practically people can take up debt beyond their limit. So I mean, a young fresh graduate earning like $3,000 a month, and when they get a credit card, and they have a credit limit of $6,000, right? But if different people are providing the same person the buy now pay later products, and he or she can ramp that up to like 10,000, even above, with no regulatory oversight. And in that regard, I think the regulators are acting a little bit slowly on that, because that's the business model. It's not hard to understand. The consequences and implications are very easy to model out. So I do think they should act fast on that to sort of rein the problems that Andrew has anticipated. But still, at the end of the day, it's a great product. I mean, it allows you to buy things that you would otherwise think twice about. I mean, maybe there are some things that you actually do need.
Yeah, sure. Just two quick comments here, right? So number one is, I don't believe people like, okay, so I'm definitely making a value judgment here in terms of what you can buy, but at lower AOVs, like at lower average order values, people are just buying like fashion and cosmetics. That's like really like the main product segments that are growing with BNPL, right? These products are not helping people access higher price point items that they wouldn't otherwise access. So this isn't like a product that's helping, a poor family buy a fridge. That's not what's going on, right? It's really people who want to buy Gucci sweaters but couldn't afford it before are buying Gucci sweaters. And if you compound it even worse, like another big trend happening in fintech is earned wage access, which is like earning your money before the end of the month so that you can take that money out. If you combine earned wage access and BNPL, you're just telling people like, don't keep your money, give it to the big guy, leverage, so that you just like live a great life, wear your Gucci sweaters at 18, right? And this is what I don't like. This isn't helping people access £1,000 of products that they couldn't otherwise afford. Right?
All fueled by TikTok and social media.
All fueled by TikTok and social media. This is the worst part, right? It gets connected to like more of that shitty advertising.
So it's a syndicate.
that
and
I
you need
used
to
do.
you need to
But
look
anyway,
at which
so
part of the syndicate you want to crack down.
it's a freaking
Yeah,
cart. It's a
yeah,
syndicate. You're
yeah.
absolutely right, and not the good kind. So okay, so this is like comment number one. Comment number two is actually this thing. So these guys are actually quite concerned about their perception of being predatory lenders, and some of them are making like extreme attempts to distance themselves from predatory lenders. Klarna charges famously no late fees, which is weird, right? Because that's arguably
Unless you're making money.
how you would make money
Yeah.
from this, right? Yeah, but they're willing to just like stick it as a payment service provider and kill other payments,
Well, that's a
payment
growth
service
strategy,
provider.
right?
But then
Yeah.
it's a growth strategy, and it also helps, it helps merchants be friendlier with merchants, and on the other side it helps them eat into payment share and therefore become as big as they did, right? And a lot of others, Laybuy, PayPal actually has a maximum cap on late fees, so you actually can't exceed, I think in the US, like for PayPal it's like $24 or something like this, like, so it's not like a large amount, because also the AOVs are small, right? So that's, I think, a pretty smart move. But the problem is like it does affect credit scores. It does affect it normalizes debt. It does affect this idea that you should be able to buy whatever you want,
Yeah.
even if you can't afford it, even if you don't have the money for it. So take out your pay earlier with the earned wage access that we now have given you, and then use that with BNPL to buy 15 different things this month. And oh, what, you don't have money to pay rent? Sorry, that's not our problem, right? And
Oh,
so
sorry.
Well, no, I mean, like, I get your point, Andrew, but I'm
Yeah,
like,
Dave.
is that the job of the company, or is that a job of like your parents to teach you financial judgment? I mean, come on, like we don't live in a nanny state, right? Like you can't
This is the McDonald's argument.
This is a McDonald's. No,
We
but
sell what people
Dude,
want.
no,
you
you,
sell
like,
what
you know what?
people want.
I
No, you sell what
I
people want,
disagree.
and you
Most
have the free
people,
choice. You give people free choice, right? I'm
dude,
like a free market.
I know
guy.
we got some hardcore libertarians in here. Like I love rights, but at the end of the day, regulations are important to ensure that people don't get yourself fucked. Once you get yourself deep in debt, it's hard to get out of it, and it's hard to then access other things in life. Debt is a huge issue, right? Most of us here, we're privileged enough to not have the kind of debt issues that most people do, but a lot of kids get into it, and then it's hard to get out of it. And I sympathize with them, but these kinds of products loop them in and get them into buying things that they shouldn't be fucking buying.
I mean, look, I think we have different opinions on this. I also think that
Yeah.
sometimes painful lessons are the best lessons, because once you've learned them, you're like, oh, I remember that time when I couldn't buy that car that I wanted because I bought a bunch of Gucci sweaters, and now maybe I should have better financial management.
But Dave, I mean, some people just fall into the trap and they can't get out of it. And I think there are more people who can't get out of it than people who can actually
Yeah.
reflect and actually learn from it. So,
Well, so this is where I
we're
agree.
dealing
I
with the
think
masses here. Yeah.
no, look, I agree with you, but this is my point. I think, yeah, to be fair, like that's where regulators come in, right? Like you have to make things that be clearly labeled, implications. Like you have to, you can't obfuscate, right? You can't, it can't be like cigarettes in the 60s where they said cigarettes don't cause cancer when they actually do cause cancer, right? So I agree with you on this, but I think as long as ultimately as everyone is transparent and we know what we're getting ourselves into, then it's ultimately up to the person's choice of whether or not they want to live outside their means.
That's the American way of thinking of things. I mean, the Chinese way
Why
is
do you
that,
think she's
okay,
in
we'll make the
Wisconsin?
choice for you. We'll make the choice for you. No more games. No more than 40 minutes of TikTok, whatever. So because I know that we know that you can't make decisions for yourselves.
Well, actually, I
Yeah.
probably needed that. Alex needed that as a kid. I probably did too. He could have gone to Harvard.
Yeah, I could have done a little bit more of that. Life would have been a little bit different.
Don't you wish you had a bit more regulation now that you
Sometimes, yeah,
realize what you've done?
So
Right? Yeah,
two-
exactly.
Yeah, go ahead.
I think,
Go ahead.
yeah.
Sorry.
No, I was just saying there's an objective function for society that somebody needs to be watching out for. Every individual can be a bit short-term focused sometimes, and sometimes you don't know the things that you don't know yet, right? When you're 18, you make a lot of stupid decisions. I made a ton of stupid decisions when I was 18, and so I wish like there were people who would just like watch out for individuals sometimes to help them get them into a better space. Yeah, Jagan.
Quickly, I think a few years ago, people were sort of bullish about lending, P2P, etc. Right? I mean, and that fell out of favor because of two things. I mean, first, people perceive that the non-performing loan, the NPL ratio, is higher than what these founders pitched, and also it's more prone to fraud. And second is that, I mean, there's lots of regulatory issues with this perceived as predatory, and then I think China has completely shut P2P. So buy now pay later is alternative where it's perceived to be safer because you actually have goods being bought against, I mean, the loans that you are giving out. And second is that from regulatory point of view, it's safer, right? I mean, because you are essentially facilitating credit for people to buy things instead of just giving people cash. But on the first point, I think the experience from friends in China over the last few years is that essentially, if you have a large ecosystem, you have lots of data points, whether you are taking cash loan or whether you are actually buying things and take loan on that thing, it doesn't really matter. I mean, at the end of the day, the sort of the NPL ratio, whatever, is very similar. It depends on how much they know about you rather than what you buy. And the second is that there are regulatory issues, but and I think that would last for a while because I don't see the regulators, I mean, figuring out how to.
Okay. Well, we'll end here.
Okay.
Good episode, guys. Good
Good
talk.
luck buying the company.
Sorry,
Alright.
guys.
Yeah, I'm off to
Good
buy
job.
movie studio now. But it's buy now, pay now.
bye.
I can't
Alright.
do buy now, pay later for movie studio.
Buy now, pay now.
Right.
Bye, guys. Good
Bye.
episode.
Bye, guys. Say bye, Jude. Bye.
Bye, Jude.
Hey, I just read a series of blogs from a Chinese blogger about sort of power and revolution, and very funny that his entire thought is based on the fact that I mean, those who succeeded in revolution are not the ones with ideas, with publicity, and with great support, but always the ones with great organizational skills.
Say again. Great.
Organizational
Organizational
skills.
skill.
I mean, able to mobilize lots of people, and and basically overthrow the old system. So then if you look at when Mussolini was in power, he was cracking down the mafia, and when the Chinese communists were basically cracking down religions. I think it's for the same reason, because they fear an alternative force which has great organizational skills, and even greater than theirs, probably. Yeah. So I was talking to my Polish intern. Yeah, go ahead.
Yeah, go ahead. Go ahead. No.
I was talking to my Polish intern yesterday, and we sort of went to discuss about why communism failed in Poland and Eastern Europe as a whole. And she said it was because people got too much power. But I said, and the communists always had too much power, like over 50 years,
exactly.
and the previous attempts like 56, 60 something, and even I think 1980 there was something. Like Hungary or some whatever, it was all cracked down, but it's only like 89, 90 when the Soviets stopped caring. When the cadres in the Soviet Communist Party stopped caring. They only care about themselves. I mean, the best, the best couldn't organize a attempt to put down Yeltsin, for example.
I mean, it's just power. That's all it is, right?
Yeah, it's how you organize like swords to seize power.
Yeah, they're essentially the real barbarians. You know?
Yep. And then the guy went to talk about the US and saying that why democracy could take roots in the US, and he said it's because the country started with armed merchants and landowners.
That makes sense.
So basically initially,
I
mean, to reach consensus, you basically have to sit down and talk, because otherwise, I mean, if you try to take over power, they will resist.
Yeah,
it's not the same case in most places in Asia.
Yeah, the civilizations were very well established for long times. Very different dynamic.
Yeah, so people are obedient.
But I guess the land ownership probably piece was missing, but the merchant trade was a huge aspect in Southeast Asia.
But merchants in Southeast Asia didn't have firepower.
They had military power relative to the region, right?
Only the East Indian Company had like significant military power, but otherwise the merchants.
If you're talking about more modern technological, yes, but there have been prior civilizations that were well more advanced than like the London or these tiny Roman cities when they first started, right? There was like Bagan was had 1 million people when London had 30,000 people, right? So I mean,
but
it's
yeah,
just,
but the people who really held the power were the kings and high priests, not merchants.
Yeah.
not
Yeah,
merchants.
correct. Yeah, exactly. Yeah, exactly. Yeah.